Well, the Fed is back at it again, talking down the stock market. All stock indices red across the board today, and bond yields actually going up, indicating selling in the bond market, suggesting that some are going, maybe the Fed is going to go a lot further than we think. Now, let's break down the comments that happened this morning and try to put them into context. So, first, context. The last summary of economic projections from the Fed suggested the Fed would raise rates to a peak of 4.6%. Since then, we got a pretty bad inflation report in October. That was followed by a pretty good inflation report here in November. But that bad one in October, based on CPI numbers from September, led the FOMC projected terminal rate to move up. Right now, we sit just below 5%. That's kind of where we think the Fed's going to go. They're going to peak out at 5%, stay there for a while. Well, today, we got Mr. Bullard, who really threw a curveball to markets. And I want to talk about whether we actually want to heed that warning or if they're trying to accomplish something else. Mr. Bullard this morning suggested the following. We need to get to a sufficiently restrictive zone of interest rates. And significantly restrictive is something that's up for debate. But he gave a range using the Taylor rule as a guide. And I'm going to break down the Taylor rule in just a moment. So if you're confused by the TR, the Taylor rule, don't worry about it. What you want to pay attention to is here. It suggests the recommended Federal Reserve's policy rate, that's the FOMC terminal rate, right, which is currently still got about 1% to go before we get to sort of the peak levels. We'll see. But based on the recommendations created by the Taylor rule, we have a generous Taylor rule calculation because you could change some coefficients in the formula. I'll show you how that works. And then we have a less generous one. In English, this scenario says inflation will be lower. This scenario says inflation will be higher. And as a result, you get this chart. It shows that presently we are here on this little blue line. And the generous version here suggests that the Fed's policy rate needs to go to 5%. Well, that's what markets are currently anticipating, is that we need to go to about 5%. But look at the less generous version. It goes all the way up to 7%. And the fact that what the market is pricing in right now is literally the bottom edge of this entire range scared the hell out of markets today. This was bad. Now, let's understand the Taylor rule and then put into context what the Fed is trying to accomplish. So, the Taylor rule was created by this guy, John Taylor, from Stanford. And there are many different formulas for it. I'm going to use a simplified version just because every single one of these pieces here can have coefficients that get changed based on certain inputs. So you can really manipulate this formula pretty intensely. But what I'm going to do is I want to show you the bias that this formula has. And then I'll tell you a little bit about this Stanford guy and kind of where his head has been. So, the way this works is you have this formula here. I'm not going to even bother reading it to you because half of you are going to click off. The only formula you need to know right now is whatever the price is of the courses on Building Your Wealth link down below, you could take 60% off using the Black Friday coupon code. And if you join Elite Hustlers, you get access to both exclusive live stream sets, the exclusive Elite Hustlers live stream set, the new lectures that come out every day the market is open, and the regular course member live streams, which after Black Friday will be exclusive for just course members of real estate and stocks and psychology money in those courses. Anyway, so not without reading you that formula, here's how it works. The Taylor rule tells you that whatever rate the Federal Reserve chooses should be determined by the rate of inflation. This makes sense. The Fed uses PCE, not CPI. That's why it's lower, and I already filled it in. And then you should add to what the inflation rate is basically how much real GDP has deviated from where it currently is. So in other words, if you want GDP to be at 1%, or let me say you want it to be at 2% and you're at 1%, you've got about a 50% deviation there. That would add another quarter of a basis point here is what you would add. Just a rough example. And you can manipulate these coefficients as well. That's why this formula gets really complicated, but I'm going to keep it simple. And then over here, you take another half times the inflation rate minus 2, and then you add 2. Okay? Very, very simply put, the bias of this rule, even if you missed all of that, the bias of this rule is the FOMC rate should be higher. Let me prove that to you. Watch this. We're going to do something really simple here. We're going to take a blue pencil here. We're going to say the deviation of GDP is 0. We're right where we want to be. Okay, great. Well, that cancels out the middle part of the formula, right? Let's say that inflation is 0. Okay, well, that cancels out the left part of the formula. If inflation is 0, then this right here is going to be 1. And that's because you take the inflation rate plus 2, which if inflation is 0, it would just be the plus 2, multiplied by 0.5, that'd be 1, plus another 2 over here. That would be a total of 3. So if GDP is right where we want it and inflation is 0, the Taylor rule says the FOMC rate should be 3%. Now, why is that important? Well, it's important because if inflation is 0 and GDP is on target, why would we need a 3% Fed funds rate? This rule was created back in 1993, and it was created by somebody who was very upset starting in 2005 for about the next, actually probably starting in 2003, for about the next 12 years all the way through 2015. He was regularly complaining that the Federal Reserve's rates were too low. In my opinion, this individual and his formula have a bias for a substantially higher FOMC rate than we're actually likely to see in the future. Now, this really gets down to your personal belief. Your personal belief, you have to ask yourself, do you think that if we removed the pandemic and all of the money printing that happened in the economy, do you believe it would make sense for the federal funds rate to be back to 2%, maybe 2.5% where it was in 2019? We were actually hiking from about 1.5% to 2.5%. Remember, Donald Trump was threatening to fire Jerome Powell, right? Do you believe we should be back at those levels? Or do you think we should follow the Taylor rule, and if inflation was in theory 0 and GDP was fine, which we did have a little bit of inflation then, which would just mean to be even higher, should the FOMC rate be 3 or 4%? See, I think Mr. Taylor and his rule are kind of stuck in the 90s and the early 2000s personally. I think that we have moved into a regime where we've come to expect lower interest rates over the long term. And if you believe we're going to return to lower interest rates over the long term, and if you kind of scale out over the past 500 years of interest rates, which is quite interesting if you do that. There are plenty of charts of this online, but let me just basically give you the bottom line of what you would see. If you look at interest rates throughout history, they've basically just done this. Oh, what drives interest rates down throughout history? Well, generally low inflation. So if you believe we're going to return to low inflation, you would expect rates to be lower, probably than what John Taylor calls for. And low inflation is generally caused by an aging population that spends less. Remember the velocity of money. One person spends $1, it creates $4 in the economy. But when you get older, you start spending less, not more, because you make less. You have less left over. People keep thinking, oh, when I retire, I'm going to be able to spend money like crazy. Wrong. You generally live off the whatever you've been able to nest egg, essentially, and then you get really worried about like not having enough and then having to go back to work, right? So you tend to spend less. So aging drives lower inflation. Globalism provides lower inflation because people who are working for $3 an hour in Caribbean islands or in South America start doing work that's worth $20 an hour in America through, Zoom or technology or the cloud Photoshop programming, whatever, right? And all of a sudden it's like, okay, well, pay the person who was making $3 $10, and you're still saving $10 as a company on hiring an American, right? Globalism, and I'm not saying that's what you should do. I'm just saying that's what drives other people's wages up, but actually drives global wages down. And that's disinflationary, especially for modern economies. So globalism, productivity, and innovation. Of course, when it becomes cheaper to have more iPhones or more iPads or whatever, what ends up happening? Well, you become more productive because you have tools that make you more productive. We've got plenty of tools that make us productive, and they allow us to, for example, be on a cruise ship and actually still upload videos to YouTube to share education. That's what I'm all about, is sharing education. Of course, you could always learn more about my education if you like my perspective in the courses on building your wealth link down below. Get in before Black Friday. It's going to be the best pricing. We always have pricing that trends up. And so you get in now, you're going to have the best pricing. But this is one of the largest coupons we've ever done. So what does this mean? Well, it potentially means, in my opinion, that John Taylor is a little too aggressive here. Why then would James Bullard of the Fed talk about Mr. Taylor and the Taylor rule? Well, for a couple reasons. One, the Taylor rule has the biggest concern over what's known as the wage price spiral. And that's the risk that ultimately people keep demanding more pay because prices are going up. Fortunately, the risk of that is becoming less severe. It was starting to get quite concerning at the beginning of 2022, which was the biggest reason I sold stocks. That risk has mostly moderated, but it's still a present risk. So what happens when, or why then, if the risk of a wage price spiral is limited, although it is still present, why then is James Bullard hawking? Why is he talking like the Fed might actually raise rates to 7% to kill inflation? Well, the reason, in my opinion, he's doing this is because the Fed has a very important job, and it is driving this chart down. Sorry, not Tesla chart. It's doing that too. It's doing that to a lot of growth and cyclical stocks. This particular chart is a chart of the 5-year break-even rate of inflation. If you've been watching this channel, you've seen me watch this pretty closely. It was doing great all the way up to about October. And that's where the Fed lost it, where all of a sudden this darn chart starts exploding. And it really took the last FOMC meeting for Jerome Powell. Remember when that reporter asked the stupid question? It's like, hey, the market seems to be going up. It was going down. And then Jerome Powell just lets it rip and talks about all the reasons why the Fed has to work harder and raise rates more. The Fed wants financial conditions to be tight. That's what we learn almost every day from Nikki Leaks. They want tight financial conditions. They want layoffs. They would never politically say that, but let's be real. That's what they want. They want layoffs. They want lower risk of a wage price spiral. When you lay a lot of people off, what signal does that send to employees? It sends a signal that, oh crap, I better not quit or get fired because I might have a hard time finding a job somewhere else. And that's very different from the mentality of, oh, fire me, I don't need to be productive here, I'll go get another job that'll pay me more. You know, that's kind of like what you had in 2021, was this belief that you can't get hurt. And boy, have those things changed. But take a look at this. Because of the Federal Reserve's yapping and that weaker inflation report that we just got in November, we've actually thankfully seen a really nice relaxation of this curve. This is very important. But this is what the Fed is doing. You could see that inflection point right here would actually steepen down. The Fed will do whatever they need to do to come out and publicly talk inflation down. And they want this break-even curve to be even lower than this point where it was over in September, because if you go 5 years back, that point was just as high as what it was in 2019 when they were hiking. So you have a Fed who has a job, and their job is to basically, until we get multiple reports in a row showing that inflation is going down, they are just going to come out day after day after day after day, and they're going to talk the market tight. That's what they want. They're always going to look for the bad news. Oh, that's just one good report. And then as soon as 2 good reports come out, like CPI and PPI, well, 2 reports isn't the start of a trend. And I guarantee you, when Bullard came out this morning, okay, I can't guarantee this, but I can only guarantee a 60% off coupon code. I guarantee, again, I hashtag don't guarantee, but I almost guarantee you that after Bullard talked markets red this morning, Jerome Powell and them were like, heck yeah, bro, you did it. You crash markets. Good thing we sold out right before we started tightening, huh? All under the guise of, let's just get out of the market so we're not biased. Yeah, not shady at all. Anyway, there you have it. So what's going on with the Fed's great reset trajectory? Well, ultimately, it comes down to what actually happens with the data. But in terms of your investing and positioning, you have to ask yourself, what's more likely? Are we going to go back to a low inflationary regime, modern monetary theory, zero or negative interest rates? I would say that's probably 80 to 90% likely. We can disagree about that, of course. The whole point of sharing perspective is not that you become a zealot and listen and agree with everything I say, right? And I think there's maybe a 20% chance that we end up going into a direction of consistently higher levels of federal funds rates, that maybe 4 or 5% just becomes the new normal. And we just sit here for years. That's going to be devastating for real estate, like really devastating for real estate. It's one thing if we go back to ZIRP, zero interest rates, real estate will be fine. It'll rebound so quickly. But if you're looking for more affordable real estate, unfortunately, there's no right answer for you, because as FOMC rates stay high, mortgage rates stay high. So it doesn't, and even though prices might come down, it doesn't really increase your affordability, which is pretty terrible. You would need a substantially massive correction. Anyway, so that gives you some insight. If you found this helpful, consider sharing the video. Thank you for watching. Subscribe, and we'll see you in the next one. Good luck, everybody. Bye.